The day your paycheck stops, the tax system you spent your whole working life leaning on stops with it. That is the first thing I would want you to understand, and I would want you to understand it fast. When you had a job, taxes were handled quietly in the background. Your employer withheld money, Social Security came out, Medicare came out, federal income tax came out. You did not have to build a system, somebody else built it for you. Then retirement arrives, and most people make a dangerous assumption. They think the old machine is still running. It is not. There is no letter from the IRS saying, here is what changes now. There is no government checklist that lands in your mailbox the week after you retire. There is no pleasant conversation where somebody explains how Social Security interacts with ERA withdrawals, how Medicare premiums can jump because of one mistake, or why a penalty can show up even when you thought you were doing everything responsibly. I have watched too many decent, disciplined people lose money in retirement, not because they were reckless, not because they were foolish, but because nobody explained what the IRS expects the moment wage withholding disappears. If I were sitting across the table from a retiree today, I would say this as plainly as I know how. Retirement is not the moment to stop paying attention to taxes. It is the moment you finally become the payroll department, the withholding department, the planning department, and the mistake department all at once. That sounds harsh. It is also true. And once you accept that truth, the path gets much clearer. The first thing I would do is set up estimated tax payments before the IRS decides to teach me a lesson with penalties. When you were working, the system collected your taxes throughout the year. In retirement, your income is going to arrive from different directions. Maybe you have Social Security, maybe you have a pension, maybe you take money out of an IRA, maybe dividends show up, maybe rent checks show up, maybe you sell something and realize too late that the IRS considers that part of the year's story too. The problem is not that these sources exist. The problem is that many of them do not withhold enough tax, and sometimes they do not withhold anything unless you actively tell them to. That is how retirees get surprised. They file in April thinking they might owe a little, and then they discover they underpaid all year long. Now they owe the tax they should have paid, and on top of that they owe a penalty because the IRS does not merely care what you pay. It cares when you pay it. I want you to think like an owner here, not like an employee. Owners understand cash flow timing. Owners understand that if the bill is due quarterly, waiting until the end of the year is not discipline. It is drift. The quarterly deadlines matter: April, June, September, January. If you do not build a routine around them, you are not managing your retirement income. Your retirement income is managing you, and there is something else many people never hear. The safe harbor rule is one of those quietly valuable rules that can save you from a very annoying penalty. If you pay enough during the year based on last year's tax liability, the IRS generally leaves you alone on the underpayment issue, even if this year ends up looking different. That is not glamour. That is not a clever hack. That is just good operating procedure. In investing, I have always preferred systems over drama. This is one of those places. Now suppose you did retire recently and you made an honest mistake. Suppose you are over 62, retired within the last 2 years, and did not know what had to be done. There may be a waiver route, but I do not like living by mercy when I can live by preparation. I would rather build the system before the penalty appears than beg to remove the penalty after it lands. That brings me to the second thing. If you are collecting Social Security, I would not leave withholding to chance. I would decide deliberately whether to file the form that withholds taxes from those checks. This shocks many people the first time they hear it. They spent decades paying into Social Security, and then they reach retirement only to learn that part of those benefits can become taxable depending on the rest of their income. That anger does not change the math. The question is not whether it feels fair. The question is whether you will handle it intelligently. If you know some of your Social Security may become taxable, why wait for spring to discover the bill? Why not have some withholding built in along the way? I have seen too many people treat Social Security as untouchable money, then watch a tax bill form around it because IRA withdrawals, investment income, or pension income push them into a zone they never planned for. I prefer fewer surprises in life, especially expensive ones. A simple withholding election can turn a chaotic tax season into a manageable one. Not perfect, not painless, but manageable. And manageable is underrated. The third thing I would study is the formula that determines how much of your Social Security becomes taxable, because this is where a lot of retirees think they are in a low bracket when they are actually walking into a trap built out of interaction effects. This is where retirement taxes stop being intuitive. Many people think in straight lines. I earned this much, so I pay this rate. That is not how this zone behaves. The formula pulls in your adjusted gross income, tax-exempt interest, and half of your Social Security. Then thresholds decide whether up to half your benefits become taxable or up to 85% of them do. And what makes this so pernicious is that the thresholds were set a very long time ago and never moved with inflation. That means what once looked like a comfortable income now catches ordinary retirees who are not living extravagantly at all. This is what I mean when I say that retirement is not automatic. You can do ordinary things and still trigger extraordinary inefficiency. $1 extra is not always just $1 extra in this zone. Sometimes $1 extra drags more of your Social Security into the taxable column. That means the real bite can be much larger than you expected. I have always admired simple arithmetic retirement taxation. In this area is not simple arithmetic. It is interaction arithmetic. So if I were planning withdrawals, selling appreciated assets, doing Roth conversions, or even deciding when to claim income from different sources, I would want that formula on the table in front of me. I would not guess. I would not rely on vague impressions. I would run the numbers. That leads naturally to the fourth thing. And this one is the sort of detail most people miss because they assume tax software will catch it for them. I would make sure the new senior deduction available to eligible older taxpayers is actually being claimed. People assume the tax code is stingy in one direction only. It is not. Sometimes it is stingy because you do not know what is there. Sometimes it is stingy because your preparer is moving too quickly. Sometimes it is stingy because the software did not flag the issue and nobody asked one extra question. You do not need to be cynical to protect yourself. You need to be specific. If Congress creates a deduction for older taxpayers and you qualify, then that deduction is not a trivia fact. It is part of your operating income. If it saves you taxes, it has the same economic value as investment income, pension income, or a reduction in your monthly expenses. Money you do not unnecessarily send away is still money. I have spent my life looking for edges that compound. Some are huge, some are boring. The boring ones are often easier to keep. A retiree who never asks whether a new deduction was applied is trusting the process at the precise moment the process becomes most fragile. Ask directly, was it applied? Do I qualify? If I already filed without it, can I amend? That is how adults protect themselves. The fifth thing I would know cold is when required minimum distributions begin, because one of the most expensive errors in retirement is paying a penalty on money the government was going to make you withdraw. Anyway, this is the sort of mistake that is too silly to make and too common to ignore. If you own traditional retirement accounts, the government eventually wants its share. That is the whole point. You got the deduction or the tax deferral on the way in, and now the IRS wants the taxable income on the way out. Whether you like that arrangement is irrelevant. The clock runs anyway. The first RMD has a deadline. Everyone after that has a deadline. And the trap, of course, is that delaying the first one into the following year can create the illusion of flexibility while actually stacking two distributions into one tax year. That is how people wander into a higher bracket without meaning to. That is how more of their Social Security becomes taxable. That is how Medicare premium surcharges begin to show up later. That is how a decision that looked harmless in isolation turns costly in combination. I do not object to complexity as a fact of life. I object to complexity when the people affected by it do not even know it exists. So I would mark the first RMD date clearly, calculate the amount clearly, and decide deliberately whether taking it in the year I turn the eligible age is cleaner than pushing it into the following spring. The penalty for missing one is not trivial. Even reduced penalties are still absurd when the underlying mistake was simply not understanding a calendar. Calendar mistakes are some of the dumbest expensive mistakes in finance. The sixth thing I would consider is whether charitable giving should come directly from the IRA through a qualified charitable distribution rather than from my checking account after I have already paid tax. This is one of those moves that separates casual retirement management from intelligent retirement management. If you plan to give anyway, the source of the gift matters. People often think only in moral terms about charity. I admire the moral term, but the tax term matters too. If the distribution goes directly from the IRA to the charity and qualifies, you may satisfy part or all of a required minimum distribution without having that amount swell your taxable income. That means less adjusted gross income. That means less pressure on the Social Security tax formula. That means less risk of higher Medicare premiums. That means the exact same charitable intent, routed in a much more intelligent way. This is what I mean by designing the system instead of drifting through it. You can be generous and strategic at the same time. In fact, the tax code often rewards exactly that combination. A retiree who writes a check from the bank account after taking a fully taxable IRA withdrawal may feel virtuous. A retiree who routes the gift through a QCD can feel virtuous and efficient. I prefer both. The seventh thing, and perhaps one of the most powerful long-term decisions in the early years of retirement, is the Roth conversion during the gap years. This is where real planning begins to separate itself from passive retirement. There is a window that opens for many people after work income stops and before required minimum distributions and sometimes before Social Security begins. Those years can look strangely quiet on a tax return. Quiet years are not empty years, they are opportunity years. If your bracket is lower than it is likely to be later, paying some tax deliberately now can save a larger tax headache later. That is what a Roth conversion is really about. It is not magic, it is timing. You move money from a future taxable environment into a future tax-free environment, while the current tax toll is relatively more tolerable. Then the future growth occurs in the Roth. No future RMD during your lifetime. No additional tax on qualified withdrawals. More control, less forced income later. And there is another advantage when markets are weak. If account values are down, you can convert at a lower dollar value, pay tax on that lower amount, and let the recovery happen inside the Roth. I like buying wonderful assets when they are cheaper. The same logic in a different form applies here. If you know you will likely convert anyway, doing it after a decline can be meaningfully more efficient than doing it after a rebound. Of course, the discipline here is critical. You do not convert blindly. You convert with brackets in mind. I would not spill gratuitously into a higher bracket simply because I fell in love with the idea. The intelligent move is to fill the current bracket thoughtfully, not to lunge. Still, every year you waste in the gap years is a year you cannot recover. Retirement planning has a cruel feature. Opportunities expire in one direction only. The eighth thing I would watch with a paranoid level of respect is Medicare surcharges. What many retirees come to know only after the bill arrives. I have long believed that hidden thresholds do more damage than obvious taxes, because people do not feel them approaching. A large IRA withdrawal, a big Roth conversion, a capital gain, the sale of a property, a distribution timed poorly. Any of these can raise income enough to trigger a Medicare premium increase later, because the system looks back at prior tax returns. That means a one-year income event can reach forward and raise your monthly healthcare cost for the next cycle. This is the sort of thing that makes retirees say, "Nobody told me." That sentence is tragically common in retirement. If an income spike was genuinely tied to a major life event and relief is possible, then relief should be pursued. But again, I prefer avoiding the avoidable rather than pleading after the fact. If I can spread income over years, manage the size of a conversion, or choose a cleaner timing window, I want to do that before the premium formula turns my inattention into an annuity of irritation. In retirement, Little recurring costs matter. They matter because they pile up. They matter because fixed-income households feel them faster. And they matter because once you reduce a recurring outflow, the benefit compounds every month without requiring one extra ounce of market genius. The ninth thing is simple and almost embarrassingly basic, which is probably why it gets missed so often. Update your address with the IRS and open every letter. Immediately, I am always amazed by how many otherwise careful people will manage six-figure accounts and then toss a government envelope on a counter for 3 weeks because they do not want to deal with it today. Deadlines do not care how you feel today. If you moved when you retired, downsized, relocated to be near family, or changed states for tax reasons, you must assume that every agency is behind you until proven otherwise. If a notice goes to the old address and the deadline, the practical damage is the same as if the notice had gone to you and you ignored it. That is why the address itself is a financial control. And every IRS letter has a different weight. Some are notices, some are mismatch letters, some are balance due letters, some are final warnings before collection actions. Intensify. The person who opens them immediately retains options. The person who lets them stack up in a drawer is trading optionality for dread. I have no affection for dread as a strategy. Retirement is supposed to reduce chaos, not increase it. 5 minutes spent reading a letter the day it arrives is infinitely cheaper than 5 months spent untangling a preventable escalation. The 10th thing I would review every single year, without exception, is whether the standard deduction or itemizing is better. This is where autopilot becomes an enemy. People got used to one set of rules, especially after major tax law changes years ago, and then they stopped checking. That is understandable. It is also costly. Deductions change, caps change, personal situations change, mortgage and charitable giving changes, senior add-ons change. New deductions appear. Thresholds move. 1 year is not the next year. In other words, yesterday's filing habit is not a tax strategy. For many older taxpayers, the standard deduction plus the extra amounts available to seniors, plus any newer senior. Focused bonus deduction may create a surprisingly large amount of income shielded from tax. In other cases, especially in higher tax states or households with meaningful deductible expenses, itemizing may once again become the superior path. The key lesson is not which one wins universally. The key lesson is that the winner must be recalculated, not inherited from last year's memory. I will put it plainly, filing the same way, because that is how you filed for the last 8 years, is not prudence. It is laziness wearing a prudent costume. At this point, a retiree might say, "This is too much. I worked 40 years. I thought retirement was supposed to be simpler." I understand the emotion, but here is the good news, hidden inside all this complexity. Most retirees are not losing money because the rules are impossible. They are losing money because the rules are invisible until somebody names them. Once named, most of these moves are entirely manageable. Estimated payments are manageable. Social Security withholding is manageable. The provisional income formula is manageable, if you respect it. The senior deduction is manageable. RMD timing is manageable. QCDs are manageable. Roth conversions are manageable with planning. Medicare surcharges are manageable if you understand the thresholds. Address changes and IRS mail are manageable. The deduction choice is manageable. If you rerun the math, that is the real message I would leave with anyone retiring now. You do not need panic. You need a checklist. You do not need to become a tax lawyer. You need to stop assuming the old paycheck machine still exists. You do not need brilliance. You need attention. And if you give attention to these 10 places before the mistakes happen, retirement becomes what it should have been all along. Not a period of passive confusion, but a period of controlled, deliberate stewardship. I have spent a lifetime thinking about capital allocation, incentives, tax drag, and the difference between activity and progress. Retirement taxes are just another version of the same old lesson. The money that stays in your hands compounds for you. The money that leaks out through penalties, bad timing, hidden thresholds, and lazy filing habits compounds for somebody else. I know which side of that equation I prefer. So if I had to reduce everything I just said to one sentence, it would be this. The IRS expects you to take over the system the moment you retire. If you do not, the cost will not arrive as one giant disaster. It will arrive the way most financial pain arrives, quietly, repeatedly, expensively. And that is exactly why I would start building the retirement tax system before the first surprise teaches me to. Let me walk through the sequence one more time, the way I would want an intelligent retiree to hear it. First, make sure enough tax is getting paid during the year instead of hoping April will be merciful. Second, if Social Security is part of the plan, decide whether withholding should come directly out of it rather than pretending the tax issue will sort itself out. Third, understand the formula that taxes benefits, because one extra stream of income can do more damage than it appears to do on the surface. Fourth, make certain every deduction available to older taxpayers is actually making it onto the return instead of vanishing into software indifference or preparer haste. Fifth, know when mandatory withdrawals begin, because the government is patient until it is not. Sixth, if you are charitably inclined, do not donate in the least efficient way, merely because it feels familiar. Familiar and intelligent are not the same word. Seventh, use the quieter tax years before required distributions arrive to reshape the future map of your accounts while you still have the leverage to do it. Eighth, remember that healthcare costs are not separate from tax planning and retirement. They are often downstream from it. Ninth, treat every IRS letter like a ticking clock rather than a nuisance. 10th, rerun the deduction math every year, because the retiree who files on autopilot is usually financing the government more generously than necessary. That is not a scary list to me. That is a liberating list. It is liberating because each item turns vague retirement anxiety into something concrete, something measurable, something you can fix on a Tuesday afternoon instead of regretting on a Friday night in March. The overwhelming majority of painful retirement mistakes are not acts of financial genius gone wrong. They are acts of administrative neglect. They are forms not filed, elections not made, thresholds not understood, deadlines not marked, letters not opened. A bad sequence of small omissions can be more destructive than one spectacular blunder. People spend their working lives thinking retirement risk is the market. Sometimes it is, but often the first real retirement losses come from taxes, penalties, surcharges, and timing errors that have nothing to do with whether the SP is up or down that month. That is why I would tell any new retiree to think like a chief financial officer for their own household. You are not merely spending now, you are coordinating. You are deciding which dollars arrive first, which dollars are taxed now, which dollars are delayed, which dollars get converted, which dollars trigger hidden formulas, and which dollars stay protected from unnecessary drag. That sounds like work. It is work, but it is the kind of work that buys peace. I have never minded work that buys peace. And if you build that peace correctly, retirement changes character. It stops feeling like a cliff and starts feeling like what it should be. A period where your capital, your planning, and your judgment finally begin serving you in a more orderly way than your employer ever did. That is the difference between a retiree who keeps asking, "Why did nobody tell me?" and a retiree who quietly keeps more of what they earned. I have always preferred the second kind.